Let's go to some stock picks. We haven't got time for your view, Cobus. But Cobus, you're going with Reinet. There were a couple of questions coming through around the rumours this morning. The sense was response to recent speculation. They have had an offer for their PRC business, and it's your pick today.
Yes, so we had, I guess, reasonably robust financial journalists calling a 45 billion pound deal for roughly a 50% stake, and of course in Pence Corp, and of course Reinet owns 49.5, so they will certainly be part of that conversation. Part of the reason we have reiterated this as a buy is that this essentially becomes a new peg in terms of the valuation of that business. Yeah. To give you an idea, the last carrying value, and the nice thing about Reinet is because of the Luxembourg listing, it does report full earnings every 3 months. The carrying value for that stake as of last reading was 3.4 billion. So writing that up to call it the mid-range, or even the bottom of the range, 4 billion for that stake. I mean, given that it seems that these things are in play, and that's been quite a coherent strategy of the private equity players in collecting these pension fund benefits companies, they are quite attractive, and Pence Corp has been executing particularly well under the leadership of some phenomenal management. So there are sort of two likely outcomes: is they sell or they don't sell. And then if you want to follow your binomial tree somewhat further, is it then worthwhile for them to remain listed? Yeah. Do they collapse the structure? So even if they don't accept the offer and remain listed, this becomes an enormous, call it write-up in the potential value of their most significant asset. So that unlocks significant value, and that, frankly, at the spot price is not even being reflected. If we rewrite those assets up to the bottom of the range, it's still trading at around, call it a 5% short of where it should be relative to what the implied value of that asset on Friday. And if they do end up selling, and as a double whammy, collapsing the structure and returning capital to investors, there's more than 50% upside from this level. So on that basis, there's a lot of optionality here. We think it's undervalued even if they do refuse the deal, but there's a high likelihood of some sort of deal unlocking significant value for shareholders. Yeah.
A ton of cash there. Alex, Altron, been a pick of yours before, a good business and looking better by the day in some cases.
Yeah, certainly. I've been very impressed with what management's been doing there over the last couple of years, and I think there's still more to come. So I think specifically the platforms business, which is more annuity type business. Mm-hmm. Think of your a Netstar and your fintech and so forth. I think there's probably strong growth coming from those businesses, and I expect very strong earnings growth, probably in the region of, call it 15%. But I think the key for me is if you look at the cash earnings of this business, it is substantially higher than accounting earnings. And one of the reasons for that is because of the depreciation policy they use on these actual devices at Netstar. Gotcha. Now, they are going to consider to change that. That is going to change, and I think they're certainly justified to change that. That's going to mean even higher earnings growth and higher ROEs, and I don't think that's reflected in evaluation or in consensus earnings numbers. So I think there's a price to both sides. So as a result, I think you should look to buy it now, and you'll probably get the benefit 6-12 months from now.
I like that. A small tweak in the earnings, and suddenly a whole lot gets unlocked. But we'll leave it there. That's all for Stockwatch today. Thanks to our guests, Alex Duys, Umthombo Wealth, Cobus Potgieter from Southern Cross Capital. Up next, the close. Stay watching.
Thank you.